Hello everyone. This video is in continuation with the previous video on financial statements for companies. Let's start with the meaning of capital and its types. Capital means amount invested in the business for the purpose of earning revenue. In case of a company, money is contributed by public and people who contributed money are called shareholders. Now let's start with the types of capital. First one is authorized capital. It is also called as nominal or registered capital. It is the maximum amount of capital a company can issue. It is stated in Memorandum of Association. Next one is issued capital. It is part of authorized capital which is offered to public for subscription. It cannot exceed authorized capital. Third one is subscribed capital. This is the part of capital which is subscribed by the public. Next one is called up capital. It is the amount of nominal value of shares that has been called up by the company for payment by the subscriber towards the share. Next one is paid up capital. It is part of called up capital that the members of company or shareholders have paid. Last one is reserve capital. It is part of increased capital or a portion of uncalled share capital of an unlimited company which can be called only in case of winding up of the company. Now, let's move to financial statements. Financial statements as per section 20 subsection 40 of the Companies Act 2013 inter alia includes number 1, a balance sheet as at the end of the financial year. Number 2, a profit and loss account, or in the case of a company carrying on any activity not for profit, an income and expenditure account for the financial year. Thirdly, cash flow statement for the financial year. Fourth, a statement of changes in equity if applicable. And lastly, any explanatory note annexed to or forming part of any document referred to in subclause 1 to subclause 4. Provided that the financial statement with respect to one person company, small company, and dormant company may not include the cash flow statement. Now, what is the requisite of financial statements? It shall give a true and fair view of the state of affairs of the company as at the end of the financial year. Now, moving on to the points to be kept in mind while preparing final accounts. Requirements of Schedule 3 of the Companies Act. Part 1 includes balance sheet and Part 2 includes profit and loss account. Another point to be kept in mind while preparing final account is other statutory requirements. Moving on to the next thing which is to be kept in mind is accounting standards issued by Institute of Chartered Accountants of India on different accounting matters and notified by the central government. Next one, statements and guidance notes issued by the Institute of Chartered Accountants of India which are necessary for understanding the accounting treatment, valuation, disclosures suggested by the ICAI. Now, we will discuss the format of balance sheet as per Schedule 3 of the Companies Act 2013. Now, as we have already discussed, Part 1 consists of format of balance sheet. It starts with the name of the company, which can be anything, for example, XYZ Limited, and balance sheet as at, most probably in most of the cases, it is 31st March and the year. Now we will discuss the format of balance sheet. We also call it vertical balance sheet. Now, as we can see, first column includes particulars and second one includes note number. In third column, we can see figures as at the end of current reporting period, and fourth one includes figures as at the end of previous reporting year. Now, firstly, we have equity and liabilities, and on the other hand, we have assets. Now, equity and liabilities have been further classified into four categories, that is, share application money, pending allotment, non current liabilities, and current liabilities. So, shareholders' funds includes share capital, reserves and surplus, money received against share warrants. Non-current liabilities includes long-term borrowings, deferred tax liabilities, other long-term liabilities, and long-term provisions. Current liabilities includes short-term borrowings, trade payables, other current liabilities, and short-term provisions. Now, this brings end to the liability side of the balance sheet. Moving on to the asset side, which is further classified into non-current assets and current assets. Non-current assets are fixed assets such as tangible assets, intangible assets, capital work in progress, intangible assets under development. And another type of non-current assets is non-current investments, deferred tax assets, long-term loans and advances, and other non-current assets. Moving on to the types of current assets, that is current investments, inventories, trade receivables, cash and cash equivalents, short term loans and advances, and lastly, other current assets. With this, we get the total of assets side 2. Now, let's talk about liabilities and equities in detail. First one is shareholders' funds. Now, what is share capital? We have already discussed it. So, equity share capital and preference share capital are to be shown separately. That means under the head share capital, we will mention equity share capital as well as preference share capital. Next one is reserves and surplus. Now, the following items are to be shown under this head: capital reserves, capital redemption reserve, securities premium, debenture redemption reserve, revaluation reserve, share options outstanding account, other reserves, and lastly, surplus, that is balance in the statement of P&L account. The balance of reserves and surplus after adjusting negative balance of surplus, if any, shall be shown under the head reserves and surplus even if the resulting figure is in negative. Lastly, money received against share warrants. Second one is share application money pending allotment, which is to be written as it is. Now, moving on to non-current liabilities, which includes long-term borrowings, for example, debentures, bonds, bank loans, long-term loans, mortgage loans, public deposits, etc. Next one is deferred tax liabilities. Moving on to the next item in non-current liabilities, that is other long-term liabilities such as intercompany owings from associates, subsidiaries or other companies, and long-term trade payables. Long-term provisions such as provision for employee welfare fund, provident fund, gratuity fund, provision for warranties, and provision for pension fund. Now, moving on to current liabilities, first one is short term borrowings. It includes loans repayable on demand from banks and other parties, bank overdraft, and cash credits. Next one is trade payables. It includes sundry creditors, bills payable, and outstanding expenses. Next one is other current liabilities such as unpaid dividends, interest accrued and due or not due on other borrowings, income received in advance, calls in advance, outstanding interest on calls in advance, and last one is short term provisions such as provision for tax and proposed dividend. Now, moving on to the other side, that is asset side. First one is non current assets. And under the head non current assets, first one is fixed assets. Now, it includes tangible intangible and capital work in progress. Tangible assets, for example, land, building, plant and equipment, furniture and fixture, vehicles, office equipment, livestock, railway sidings, etc. And intangible assets include goodwill, brand or trademarks, computer software and mining rights, masthead and publishing titles, copyrights and patents, and other intellectual property rights, recipes, formula, models, designs, and prototypes. And last one is licenses and franchisee. And third one is capital work in progress. And lastly, fourth one is intangible assets under development like patents, intellectual property rights, etc., which are being developed by the company. Now, moving on to non current investments such as investments, trade investments, and non trade investments. Third one is deferred tax assets. Fourth one, long term loans and advances. It includes only capital advances and security deposits. And last part of non current assets is other non current assets. Preliminary expenses, discount on issue of shares or debentures, underwriting commission, deferred revenue expenses, discount on issue of shares, debentures, and share expenses. Now, let's talk about current assets. It includes current investments such as investments in equity instruments, preference shares, government securities, debentures, and mutual funds, etc. Next one is inventories. Inventories include the following. First one is raw material, work in progress, finished goods, stock in trade, stores and spares, and third component of current assets is trade receivables. It includes debtors and bills receivables. Next one is cash and cash equivalents. As discussed in the salient features of Schedule 3 in General Instructions, balance with banks, checks, cash in hand, and deposits with bank. Another one is short term loans and advances. And last one is other current assets. It includes prepaid expenses, accrued income, interest accrued on investments, advance tax, etc. There is an example given to us. The statement says, from the following trial balance of Vishal Limited, prepare the balance sheet of the company as on 31st March 2015 as per Schedule 3 of the Companies Act. And the trial balance as on 31st March 2015 is given. It is having two sides, debit and credit. Expenses are shown on left side, that is debit side, and sources of incomes have been disclosed on right side, that is credit side. Now, let's move to the solution. We'll start with liabilities side, that is equity and liabilities. First head is shareholders funds, which includes further share capital and reserves and surplus. Other things are not given in the question. Share capital is 52 lakh, reserves and surplus is 1 lakh 2,980. Second head is share application money pending allotment, which is not given in the question. Moving on to non-current liabilities, which is further divided into long-term borrowings and long-term provisions. Long-term borrowings are 8 lakh dollars and long-term provisions is 6 lakh dollars. Now, the last one is current liabilities. Short-term borrowings, which is equal to 4 lakh $90,200. Trade payables, 1 lakh $85,120. Other current liabilities, which comes to be $64,800. And last one, short-term provisions, which is equal to 1 lakh $64,000. So the total of liability side comes to be 76 lakh $7,100. Now moving on to the asset side, which further includes non-current assets. it is classified into fixed assets and other non-current assets. Under fixed assets, we will mention tangible assets as 48 lakh 59,940 dollars and intangible assets as 10 lakh dollars. Other non-current assets are of $25,000. Moving on to current assets, that is current investments $3,36,000, inventories $3,55,600, trade receivables $3,66,240, cash and cash equivalents as $3,14,320, short-term loans and advances as $3 lakh, and last one, other current assets as $50,000. So again, the total of asset side is 76 lakh $7,100. So at the end, what we get is the balance of both the sides is always equal. It always tallies. Now, how did we calculate reserves and surplus? As we have talked in the solution, the value of reserves and surplus was 1,02,980. It came to be like it was calculated as capital reserve 60,000 and P&L credit balance 42,980. The total comes to be 1,02,980. And moving on to trade payables, which was equal to sundry creditors plus bills payable, which is 1,20,000 and 85,100 respectively. The total of trade payable comes to be $1,85,120. And tangible fixed assets is equal to premises plus furnitures and fixture. The value of premises was 41 lakh $9,940 and the value of furniture and fixture is $7,50,000. So the total comes to be 48,59,940. As we are done with the balance sheet and its format, now let's move on to the format of P&L account as per Schedule 3rd of Companies Act 2013. Now the part 2 includes statement of profit and loss, name of the company, which can be anything like XYZ Company Limited, and P&L statement for the year ended most probably 31st March 2015, 16 or 17. It can be anything. Now, as we can see its format, it is divided into 4 columns. First includes particulars, second one note number, third one figures of current year, and fourth one includes figures of previous reporting year. Now first head is revenue from operations, secondly other income, and third one is the total of 1 and 2 which is equal to total revenue. Now fourth one includes expenses such as cost of materials consumed, purchases of stock in trade, changes in inventories of finished goods, work in progress and stock in trade, employee benefit expenses, finance cost, depreciation and amortization expenses, other expenses, and at the end we get total expenses. Now we will find profit before exceptional and extraordinary items and taxes, which is equal to total revenue minus total expenses. Now this is our fifth head. Moving on to the sixth head, that is exceptional items, and seventh one is profit before extraordinary items and tax, that is equal to fifth head minus sixth one. And the next one is extraordinary items. Now what we get after it is profit before tax, which is equal to seventh head minus eighth head. Moving on to the 10th item, that is tax expenses, which is current tax and deferred tax. Now after it, we calculate profit or loss for the period from continuing operations, which is equal to 7th minus 8th head. Moving on to the 12th one, that is profit or loss from discontinuing operations. And 13th one is tax expense of discontinuing operations. 14th one is profit or loss from discontinuing operations, that is after tax, which is equal to 12th minus 13th head. And 15th one is profit or loss for the period, which is equal to 11th plus 14th head. And last one is earnings per equity share, which is 16th head, which includes basic and diluted earnings. Now, let's take the help of a numerical example. As you can see on the screen, you are given the following extracts of ledger balances from Chanakya Company Limited for the year ending 31st March 2015. Now we are supposed to prepare a statement of P&L account as per revised schedule 3. Under the first head, revenue from operations, the total is $6,36,500 and other income comes to be $16,400 and total revenue is 1 plus 2, which is equal to $6,52,900. Moving on to the fourth item, that is expenses, which includes material consumed 2,92,000, purchases equal to 0, changes in inventories, which is 12,500 in negative, employees benefit expenses $1 lakh, finance cost $16,250, depreciation and amortization expenses $68,000, and lastly other expenses, which is equal to $1,28,250. Now the total of expenses is $5,92,000. So at the end we get profit and loss before tax, which is equal to $6,52,900 minus $5,92,000, which is equal to $60,900. And sixth head is provision for tax, which is equal to 30,000. Now we are supposed to subtract this provision for tax from profit and loss before taxes. So at the end what we get is profit and loss after tax, which is equal to 60,900 minus 30,000. At the end we get P&L after tax is $30,900. Thank you.